Question 1. Which of the following best describes a characteristic of a variable annuity? A. It offers a guaranteed fixed interest rate regardless of market conditions. B. It provides the annuitant with the ability to choose investment options with potential for higher returns but also higher risk. C. It guarantees income payments for the lifetime of the annuitant with no options for investment in the market. D. It is only available to individuals under the age of 65. Answer: B. It provides the annuitant with the ability to choose investment options with potential for higher returns but also higher risk. Explanation: a variable annuity allows the annuitant to allocate premiums into various investment options, typically mutual funds. The performance of these investments determines the annuity's returns, meaning that the annuitant is exposed to market risk. This is in contrast to fixed annuities, which offer guaranteed returns regardless of market conditions. Variable annuities can provide the potential for higher returns, but they also carry the risk of market fluctuations. The other options are incorrect because they either describe fixed annuities, option A, or incorrectly limit eligibility, option D. Question 2. Scenario question. Mr. Anderson, age 63, is considering an annuity as part of his retirement planning strategy. He wants the annuity to provide a steady income stream for the rest of his life. However, he is also concerned about the possibility of needing funds in the event of an emergency and is considering a fixed-period annuity with a 10-year payout. What should Mr. Anderson consider when evaluating this option? A. The fixed-period annuity guarantees income for the rest of his life but is not flexible for emergencies. B. The fixed-period annuity provides guaranteed income for 10 years but will not provide income if he outlives the payout period. C. The fixed-period annuity provides flexible withdrawals for emergencies but does not guarantee any income. D. The fixed-period annuity allows Mr. Anderson to access his principal at any time during the payout period without penalties. Answer: B. The fixed-period annuity provides guaranteed income for 10 years but will not provide income if he outlives the payout period. Explanation: a fixed-period annuity provides income for a set period, e.g. 10 years, and does not guarantee payments beyond that period. If Mr. Anderson outlives the 10-year period, no further income will be provided unless he has additional annuity contracts or investment options. This is different from a life-only annuity, which guarantees income for the rest of his life. Option A is incorrect because the fixed-period annuity does not guarantee lifetime income. Option C is incorrect because fixed-period annuities do not typically allow for flexible withdrawals. Option D is incorrect because early withdrawals or access to the principal may incur surrender charges or penalties. Question 3. Which of the following is a key requirement of the Wisconsin Suitability Standard for annuity sales? A. The annuity must be offered with the lowest possible fees, regardless of the annuitant's financial situation. B. The annuity must be suitable for the annuitant based on their age, financial goals, risk tolerance, and time horizon. C. Annuity contracts must include a 30-day cooling-off period for all annuitants, regardless of age. D. The annuity must be recommended based solely on the maximum commission for the agent. Answer: B. The annuity must be suitable for the annuitant based on their age, financial goals, risk tolerance, and time horizon. Explanation: the Wisconsin Suitability Standard mandates that insurance agents recommend annuity products that are appropriate for the consumer's specific financial situation, needs, and goals. This includes evaluating factors such as the consumer's age, financial objectives, risk tolerance, and time horizon. The goal is to ensure that the annuity meets the consumer's needs rather than focusing on commission or fees. Option D. Option is incorrect because the annuity does not have to have the lowest fees but must align with the consumer's needs. Option C refers to the federal requirement of a 10-day free look period, not 30 days, and not for all annuitants, so it is incorrect. Question 4. Which of the following best describes the deferred annuity accumulation phase? A. It is the phase in which the annuitant begins receiving income payments immediately after the contract is purchased. B. It is the period when premiums are paid and the annuity value grows, but no income payments are made yet. C. It is the phase when the annuity contract terminates and the annuitant receives a lump sum. D. It is the phase when the annuity's value is locked and cannot grow or decrease based on investment performance. Answer: B. It is the period when premiums are paid and the annuity value grows, but no income payments are made yet. Explanation: a deferred annuity has two key phases, the accumulation phase and the payout phase. During the accumulation phase, The annuitant pays premiums and the annuity's value grows either through fixed or variable returns depending on the type of annuity. Income payments are not made during this phase. In contrast, the payout phase is when the annuitant begins receiving income payments. Option: it describes an immediate annuity, not a deferred annuity. Option C is incorrect because a deferred annuity does not terminate with a lump sum, and option D is not accurate as the value of the annuity can grow depending on investment performance, especially for variable annuities. Question 5. Which of the following is a feature of a fixed annuity? A. The annuity value fluctuates based on the performance of the underlying investments chosen by the annuitant. B. It provides guaranteed fixed interest rates for the duration of the contract. C. The annuitant can access the principal at any time without penalty. D. The contract includes a provision to increase payments based on inflation. Answer: B. It provides guaranteed fixed interest rates for the duration of the contract. Explanation: a fixed annuity offers a guaranteed interest rate for the duration of the contract, providing a predictable, stable income stream. The annuitant does not face market risk as the value of the annuity is not tied to the performance of investments. Option A describes a variable annuity which is subject to market fluctuations. Option C is incorrect because fixed annuities typically impose surrender charges for early withdrawals. Option D is incorrect because fixed annuities do not include inflation adjustment provisions unless a specific rider is added. Question 6. Scenario question. Mr. Gonzalez, age 58, has decided to purchase a single premium immediate annuity SPIT to provide income during his retirement. He is particularly interested in the life with period certain option as it guarantees that his beneficiary will receive the remaining payments if he passes away prematurely. Which of the following would be the most likely reason Mr. Gonzalez would choose this payout option? A. He wants to ensure that his income payments are maximized without worrying about beneficiaries. B. He wants to receive a higher payout amount even though the income stops when he dies. C. He wants to provide income for both himself and his spouse regardless of when he passes away. D. He is concerned about passing away early and wants to ensure his beneficiaries will continue receiving payments for a specified period. Answer: D. He is concerned about passing away early and wants to ensure his beneficiaries will continue receiving payments for a specified period. Explanation: the life with period certain option provides income for the annuitant's lifetime, but also guarantees that if the annuitant dies before the end of the specified period, e.g., 10 years, the remaining payments will go to a designated beneficiary. This option offers peace of mind for individuals like Mr. Gonzalez, who are concerned about providing for their beneficiaries in case of premature death. Option A is incorrect because the life with period certain option is designed to consider both the annuitant's and the beneficiary's needs. Option B describes a life-only option which does not provide for beneficiaries after the annuitant's death. Option C describes a joint and survivor annuity, not a life with period certain option. Question 7. Which of the following tax treatments applies to qualified annuities? A. Contributions to qualified annuities are made with after-tax dollars, and the income is tax-free during the payout phase. B. Contributions to qualified annuities are made with before-tax dollars, and the income is taxed as ordinary income during the payout phase. C. Qualified annuities are exempt from taxation on both contributions and income during the payout phase. D. Contributions to qualified annuities are tax-deferred, but the income is subject to capital gains tax during the payout phase. Answer: B. Contributions to qualified annuities are made with before-tax dollars, and the income is taxed as ordinary income during the payout phase. Explanation: qualified annuities are typically funded with before-tax dollars, such as through an IRA or 401k, meaning the contributions are tax-deferred. When the annuitant begins to receive payouts, the income is taxed as ordinary income at the individual's tax rate. Option is incorrect because contributions are made with before-tax dollars, not after tax. Option C is incorrect because qualified annuities are subject to tax during the payout phase. Option D is incorrect because the income from qualified annuities is taxed as ordinary income, not capital gains. Question 8. Which of the following is an example of an annuity rider? A. A feature that guarantees income payments for life, regardless of how long the annuitant lives. B. A provision that allows the annuitant to withdraw up to 10% of the principal without penalty in the first 5 years. C. A feature that adjusts income payments for inflation, ensuring they keep pace with the cost of living. D. A feature that ensures the annuity's death benefit is paid to the beneficiary even if the annuitant outlives the payout phase. Answer: C. A feature that adjusts income payments for inflation, ensuring they keep pace with the cost of living. Explanation: annuity riders are optional additions to an annuity contract that provide extra features or benefits. The rider described in option C is known as a cost of living adjustment COLA rider, which helps protect the annuitant from inflation by adjusting payments over time. Option A describes a lifetime income rider, which guarantees income for life but does not address inflation. Option B describes a partial withdrawal rider, but is not typically an annuity rider focused on income adjustments. Option D refers to a death benefit rider, which ensures the beneficiary receives a death benefit if the annuitant dies during the payout phase. Question 9. What is the primary difference between a fixed annuity and a variable annuity? A. Fixed annuities are only available to individuals over the age of 65, while variable annuities are available to all consumers. B. Fixed annuities provide guaranteed returns, whereas variable annuities allow the annuitant to invest in the market and assume the risk. C. Fixed annuities allow for flexible withdrawals without penalties, while variable annuities impose strict withdrawal restrictions. D. Fixed annuities do not offer any income options, while variable annuities guarantee lifetime income. Answer: B. Fixed annuities provide guaranteed returns, whereas variable annuities allow the annuitant to invest in the market and assume the risk. Explanation: the primary difference between a fixed and a variable annuity lies in the return structure. A fixed annuity guarantees a fixed rate of return, meaning the annuitant is shielded from market risk. On the other hand, a variable annuity allows the annuitant to invest in various securities, such as mutual funds, which can potentially provide higher returns but also carry market risk. Option A is incorrect, because both types of annuities are available to a broad range of consumers, regardless of age. Option C is incorrect, because both types of annuities may impose withdrawal restrictions, especially during the early years of the contract. Option D is incorrect, because both fixed and variable annuities can offer income options, including lifetime income riders. Question 10. Which of the following is not a common annuity payout option? A. Life only. B. Joint and survivor. C. Lump sum withdrawal. D. Inflation protected payout. Answer: D. Inflation protected payout. Explanation: common annuity payout options include life only, joint and survivor, and lump sum withdrawal. Life only provides income for the annuitant's lifetime but stops at death, while joint and survivor provides income for both the annuitant and their spouse for life. Lump sum withdrawal allows the annuitant to withdraw the entire value of the annuity as a single payment. Inflation-protected payout is not a standard payout option. While some annuities may offer riders or features that adjust for inflation, it is not an inherent payout option on its own. Question 11. Which of the following best describes the accumulation phase of an annuity? A. The phase in which the annuity begins to pay out a fixed amount of income to the annuitant. B. The period in which the annuity's value grows based on premiums paid, but no income payments are made. C. The time when the annuity is cashed out and the annuitant receives a lump sum. D. The phase where the annuitant receives income payments with no remaining value in the account. Answer: B. The period in which the annuity's value grows based on premiums paid, but no income payments are made. Explanation: the accumulation phase of an annuity is the period when the annuitant makes premium payments and the value of the annuity grows, either through a fixed interest rate or by the performance of underlying investments. In the case of a variable annuity, during this time, no income payments are made. Option A describes the payout phase, while option C refers to a lump sum withdrawal, and option D is inaccurate because the annuity has value during the payout phase. Question 12. Which of the following is the primary benefit of purchasing a variable annuity? A. The guaranteed fixed interest rate for the life of the annuitant. B. The annuitant's ability to invest in a variety of underlying investments such as stocks and bonds. C. The annuity pays a lump sum to the annuitant's beneficiary if they pass away early. D. The income payments are always higher than those of a fixed annuity. Answer: B. The annuitant's ability to invest in a variety of underlying investments such as stocks and bonds. Explanation: the key benefit of a variable annuity is the ability to invest in a range of underlying securities like mutual funds, stocks, and bonds, which may lead to higher returns but also carry more risk. The other options are incorrect because a variable annuity does not guarantee a fixed interest rate. Option A. It does not typically offer a lump sum death benefit unless specifically stated. Option C. And the income payments are not always higher than those of a fixed annuity. Option D. Question 13. Scenario question. Sarah, age 63, is concerned about the possibility of outliving her savings. She is considering purchasing an annuity to ensure she will have a consistent income stream during her retirement. Which type of annuity would best address her concern about longevity risk? A. Fixed annuity. B. Immediate annuity. C. Life annuity. D. Variable annuity. Answer: C. Life annuity. Explanation: a life annuity is designed to provide income for the annuitant's lifetime, addressing concerns about outliving their savings. It guarantees payments as long as the annuitant is alive. A fixed annuity and variable annuity could be used to generate income, but they may not guarantee lifetime income without additional riders. An immediate annuity can also provide income, but is typically structured for an immediate start and may not offer the same level of protection for longevity risk without specific features. Question 14. Which of the following best defines an immediate annuity? A. An annuity that starts paying income immediately after the contract is purchased with no accumulation phase. B. An annuity that allows for flexible premium payments and begins payouts after a period of time. C. An annuity where income is delayed until the annuitant reaches age 65. D. An annuity that provides income to the annuitant's beneficiaries after the annuitant dies. Answer: A. An annuity that starts paying income immediately after the contract is purchased with no accumulation phase. Explanation: an immediate annuity begins paying income to the annuitant shortly after the contract is purchased, typically within one payment period, e.g. 1 month. This contrasts with a deferred annuity, which accumulates value before any payouts begin. The other options describe features that do not align with an immediate annuity. Question 15. Which of the following statements about the death benefit of an annuity is true? A. The death benefit guarantees that the beneficiary will receive the total amount of premiums paid regardless of the annuity's performance. B. The death benefit guarantees that the beneficiary will receive at least the amount of the annuity's current value at the time of death. C. The death benefit is available only if the annuitant dies within the first 5 years of the contract. D. The death benefit is paid only if the annuitant chooses the life-only payout option. Answer: B. The death benefit guarantees that the beneficiary will receive at least the amount of the annuity's current value at the time of death. Explanation: the death benefit of an annuity ensures that the beneficiary will receive at least the amount the annuity is worth at the time of the annuitant's death, but it is not guaranteed to equal the total premiums paid. This provides a safety net for the annuitant's beneficiaries. Option is incorrect because the death benefit does not guarantee a return of premiums paid. Option C is incorrect because the death benefit is typically available throughout the contract, not just within the first 5 years. Option D is incorrect because the death benefit is available regardless of the payout option chosen. Question 16. Which of the following is not a common type of annuity? A. Fixed annuity. B. Variable annuity. C. Immediate annuity. D. Long-term care annuity. Answer: D. Long-term care annuity. Explanation: long-term care annuities are not a common category of annuity by themselves, although there are annuities with long-term care riders or benefits. Common types of annuities include fixed annuities, which provide guaranteed returns, variable annuities, which allow for investment in securities, and immediate annuities, which start paying income immediately after purchase. Question 17. Which of the following is an advantage of purchasing an annuity with a cost of living adjustment (COLA) rider? A. The annuity guarantees that income payments will remain fixed for the life of the contract. B. The annuity provides inflation protection, adjusting the income payments to keep pace with the cost of living. C. The annuity allows for the withdrawal of a lump sum without penalty. D. The annuity guarantees a death benefit to the beneficiary if the annuitant dies during the accumulation phase. Answer: B. The annuity provides inflation protection, adjusting the income payments to keep pace with the cost of living. Explanation: a COLA rider on an annuity adjusts income payments to account for inflation, helping ensure the purchasing power of the payments is maintained over time. This is beneficial for annuitants who are concerned about the rising cost of living in retirement. The other options do not describe the features of a COLA rider. Question 18. Which of the following is the primary advantage of a fixed indexed annuity? The annuity's returns are entirely based on the performance of a stock market index with no cap on earnings. B. The annuity provides fixed, guaranteed returns regardless of market performance. C. The annuity offers A combination of market-linked returns with a guaranteed minimum interest rate. D. The annuity allows the annuitant to withdraw funds at any time without penalty. Answer: C. The annuity offers a combination of market-linked returns with a guaranteed minimum interest rate. Explanation: a fixed indexed annuity provides returns linked to the performance of a stock market index, e.g. SP 500, but also includes a guaranteed minimum interest rate, ensuring that the annuitant will not lose money if the market performs poorly. This offers the potential for higher returns than a fixed annuity while protecting against market losses. Option is incorrect because there is typically a cap on returns. Option B is incorrect because a fixed indexed annuity combines market-linked returns with a guaranteed minimum. Option D is incorrect because annuities usually have restrictions on withdrawals, especially during the early years of the contract. Question 19. Which of the following statements is true regarding annuity surrender charges? A. Surrender charges are always waived if the annuitant withdraws the funds within the first year. B. Surrender charges are a one-time fee deducted when the annuity is initially purchased. C. Surrender charges are fees assessed when the annuitant withdraws funds before the end of a specified period. D. Surrender charges apply only to variable annuities, not fixed annuities. Answer: C. Surrender charges are fees assessed when the annuitant withdraws funds before the end of a specified period. Explanation: surrender charges are fees assessed if the annuitant withdraws funds from the annuity before the end of the specified surrender period, usually several years. The purpose is to discourage early withdrawals and ensure that the annuity provider can recover the costs associated with issuing the contract. Option is incorrect because surrender charges are not waived in the first year for all contracts. Option B is incorrect because the charge applies to withdrawals, not the initial purchase. Option D is incorrect because surrender charges can apply to both fixed and variable annuities. Question 20. Which of the following statements is true regarding qualified longevity annuity contracts? QLACs. QL et CS are annuities that allow tax-deferred growth within an individual's retirement account until the individual reaches age 591. BQL et CSR. A type of deferred income annuity that begins payouts at an advanced age, often 85, and are exempt from required minimum distribution (RMDS) until payouts begin. CQL et CS are only available through Roth IRAs and offer tax-free income for life. DQL et CS offer a guaranteed death benefit to beneficiaries, regardless of when the annuitant dies. Answer: BQLACS are a type of deferred income annuity that begins payouts at an advanced age, often 85, and are exempt from required minimum distribution (RMDS) until payouts begin. Explanation: qualified longevity annuity contracts (QLACs) are a form of deferred income annuity designed for retirement accounts which allows individuals to delay required minimum distribution (RMDS) on the portion of their retirement savings used to fund the QLAC until payouts begin, often at a later age, such as 85. This feature makes them valuable for those who want to extend their retirement savings. Option A is incorrect because QLACs do not focus on tax deferral until age 591. Option C is incorrect as QLACs can be funded through certain qualified retirement plans, but not Roth IRAs. Option D is incorrect as a guaranteed death benefit is not a standard feature of QLACs. Question 21. Which of the following is a primary reason for a client to choose a variable annuity over a fixed annuity? A. The client seeks guaranteed returns with minimal risk. B. The client wants access to stock market growth potential and is comfortable with higher risk. C. The client is seeking a fixed income payout that will not vary. D. The client requires liquidity and low or no surrender charges. Answer: B. The client wants access to stock market growth potential and is comfortable with higher risk. Explanation: a variable annuity is ideal for clients who are willing to assume greater risk for the opportunity to benefit from market growth, as variable annuities allow investments in sub-accounts tied to market performance. This contrasts with fixed annuities, which provide guaranteed returns with minimal risk but limited growth potential. Options and C apply to fixed annuities, while D is incorrect because variable annuities typically have surrender charges and lower liquidity. Question 22. Under Wisconsin law, which of the following disclosures must be provided to a client purchasing a deferred annuity? A. Only the benefits of the annuity. B. A clear summary of fees, surrender charges, and potential risks associated with the annuity. C. Projected investment returns with no mention of associated risks. D. Annuity contract details excluding the surrender period. Answer: B. A clear summary of fees, surrender charges, and potential risks associated with the annuity. Explanation: Wisconsin regulations require that insurers and agents provide clients with a detailed disclosure outlining fees, surrender charges, and potential risks. This ensures transparency and allows clients to make informed decisions. Option A is incorrect because only discussing benefits fails to provide a complete understanding. Option C ignores necessary risk disclosures, and D omits critical information about surrender periods. Question 23. A guaranteed minimum withdrawal debit ride on an annuity provides which of the following features? A. Guarantees the annuity's principal amount will grow at a fixed rate annually. B. Ensures the annuitant can withdraw a certain percentage of the initial premium each year, regardless of investment performance. C. Increases payouts based on inflation adjustments. D. Guarantees lifetime income only if the annuity account value remains positive. Answer: B. Ensures the annuitant can withdraw a certain percentage of the initial premium each year, regardless of investment performance. Explanation: a guaranteed minimum withdrawal debit allows the annuitant to withdraw a specified amount annually, typically a percentage of the initial premium, without depending on the performance of the underlying investments. Option A describes a feature of standard EBA. Option C pertains to inflation riders, and D is incorrect as GMWBS generally allow withdrawals for life even if the account value is depleted. Question 24. Scenario: Ms. Johnson, age 70, recently purchased an immediate annuity to cover her living expenses. Given her situation, which payout option would likely provide her with the highest monthly income? A. Life only. B. Joint and survivor. C. Life with period certain. D. Fixed period for 10 years. Answer: A. Life only. Explanation: the life only option generally provides the highest monthly income because it stops payments upon the annuitant's death, with no additional guarantees. Options B and C include provisions that reduce the monthly payout in exchange for survivor or period certain benefits. Option D would not provide the highest income because payments are distributed over a fixed term. Question 25. Which of the following statements best describes the tax treatment of a non-qualified annuity? A. Withdrawals are tax-free up to the amount of the original investment. B. Earnings grow tax-deferred, but withdrawals or gains are taxed as ordinary income. C. Contributions are tax-deductible and distributions are tax-free. D. Both principal and earnings are taxed upon withdrawal. Answer: B. Earnings grow tax-deferred, but withdrawals or gains are taxed as ordinary income. Explanation: non-qualified annuities are funded with after-tax dollars, allowing contributions to grow tax-deferred. However, gains are taxed as ordinary income upon withdrawal. Option is incorrect as only withdrawals up to the amount of the original investment are tax-free. Earnings are taxed. Option C applies to Roth accounts, not non-qualified annuities, and D is incorrect as only the earnings, not the principal, are taxed. Question 26. Which of the following factors does not typically influence the suitability assessment for a deferred annuity purchase in Wisconsin? A. The client's age and investment horizon. B. The financial strength rating of the insurance company. C. The client's income and tax bracket. D. The client's liquidity needs and tolerance for risk. Answer: B. The financial strength rating of the insurance company. Explanation: while the insurance company's financial strength rating may be considered in general, it is not a primary factor in the suitability assessment. Instead, suitability focuses on matching the annuity to the client's financial profile, such as age, investment goals, income, and risk tolerance. Options A, C, and D are critical to assessing suitability in accordance with Wisconsin's guidelines. Question 27. When using an annuity for estate planning, which of the following strategies would most effectively minimize probate involvement? A. Naming a trust as the beneficiary of the annuity. B. Designating the estate as the primary beneficiary. C. Choosing a joint and survivor annuity payout. D. Electing a lump sum distribution option. Answer: A. Naming a trust as the beneficiary of the annuity. Explanation: designating a trust as the beneficiary can keep the annuity proceeds outside probate, facilitating a smoother asset transfer. Option B is incorrect as naming the estate would lead to probate involvement. Option C relates to payout structure rather than probate, and option D does not impact probate status. Question 28. If an individual withdraws funds from an annuity before age 591, they may face which of the following penalties? A. No penalty if it is a non-qualified annuity. B. A 20% federal penalty on gains withdrawn. C. A 10% federal penalty on gains withdrawn in addition to income taxes. D. A penalty only if the annuity has a surrender charge. Answer C. A 10% federal penalty on gains withdrawn in addition to income taxes. Explanation: withdrawals from an annuity before age 591 were generally subject to a 10% early withdrawal penalty on any gains, along with ordinary income tax. This rule applies to both qualified and non-qualified annuities. Option A is incorrect. The 10% penalty applies to both types. Option B is incorrect, as the penalty is 10%, not 20%. Option D is misleading, as surrender charges are separate from tax penalties. Question 29. In Wisconsin, annuity contracts offered to senior consumers age 65 and above must include A. No penalty-free withdrawal period, B. A free look period during which they can cancel the contract without penalties, C. A guaranteed surrender period of at least 10 years, D. A reduced interest rate for safety. Answer: B. A free look period during which they can cancel the contract without penalties. Explanation: Wisconsin law requires a free look period in annuity contracts offered to seniors, allowing them to review the contract and cancel, without penalty, within a specified period. This is part of the state's senior consumer protections. Option A is incorrect, as most annuities include a penalty-free withdrawal feature. Options C and D do not apply to senior consumer protection requirements in Wisconsin. Question 30. Which of the following annuity riders provides additional income for long-term care expenses? A. Guaranteed minimum death benefit rider. B. Cost of living adjustment rider. C. Long-term care rider. D. Guaranteed minimum withdrawal benefit rider. Answer: C. Long-term care rider. Explanation: a long-term care rider is designed to provide additional funds to cover long-term care expenses, which can be useful if the annuitant needs such services. Option A relates to death benefits. Option B adjusts payouts for inflation, and Option D offers withdrawal guarantees but is unrelated to long-term care.